So how do you guys think about establishing criteria for an ethically oriented investment portfolio? It seems that there are a wide range of possible answers, and theoretically, you could end up with a very small investment universe of opportunities to choose from. Is there any truth to that? Kelly, why don't we start with you? Oh, sorry. No, go ahead.
No, let's mix it up. Yeah, go back to Kelly.
Oh, well, thank you. Well, again, I'm sure my panelists will agree. There are multiple opportunities to invest. I don't think that you should again think that you're going to be limited. You can start with an ethical screen. I know we've talked about crueltyfreeinvesting.org, which does a good job of making very clear these companies exploit animals, these companies do not exploit animals. And according to their website, there are just over 1,489 companies that do, 4,511 that do not. So just beginning there, you can see there is a big universe to invest in, especially if you don't want to involve yourself in animal exploitation. So, but in terms of thinking about how to strategize, begin perhaps with your ethical screens and then move on to additional screens, to these ESG ratings that we're talking about. What aligns with your values? What aligns with your investment objectives? Some of this, each of us can do on her own. For other elements of it, then we'll want to look to financial advisors into their advice and their help and their help constructing portfolios. So that'd be my big picture response.
Thank you. Claire?
I can understand where you're coming from with this question, and it's something that I guess our index has also been charged with as being, oh, there's too much in technology or too much in financials, and the problem is, I mean, as far as our screens are concerned, there are just too many damaging industries, and we are removing companies with I suppose relatively small exposure to certain things, but then you remove a large company, and then that leaves you with fewer companies to invest in. If you take out, as we do, about 48% of the S&P 500, and then you're not keeping a large amount in cash, but you're investing the whole amount, then essentially everything else is grossed up as a result. And so, those kind of biases, I suppose, result from the screens that we've imposed. And it's simply a function of the fact that if you're looking at large cap, and everybody has the most money in the large cap because it's the largest liquidity, it's the largest companies, supposedly the safest companies as well. Certainly, the larger cap index will have a lower volatility than, say, mid cap or smaller cap indices. Then that's where people have the majority of the money, and that's where we started by providing a solution for that, because otherwise there really wasn't anything. And you just can't suddenly create vegan companies from nothing, and then they kind of pole vault into the S&P 500. So starting from that universe, your choices are more limited by virtue of the fact that these very large companies are doing damaging things, and certain sectors are completely verboten. Obviously, the energy sector just drops out completely. The majority of the food sector, consumer staples sector, drops out. Big pharmaceutical stocks drop out. So I think really it's about changing society if we can, and encouraging these companies to move in the right direction so that they become investable, because that's what we want. If you have an ethical standpoint, I think you have to invest according to that ethical standpoint. But fortunately, what we have seen is that the index has been, providing similar kind of risk to the market in terms of the volatility. It hasn't caused people to be, taking dramatically more risk than they need to because of the balance that we have within the portfolio, the portfolio construction rules we're applying, particularly to the largest stocks. So we're not grossing them up as much as we theoretically should if we were just operating on a market cap basis. And so with those kind of measures, I think you have enough there, and you can avoid excessive concentration.
Sucheta?
Yeah, I'd just like to add a little bit here about shareholder engagement, because I think this is also a very important point. And I think Claire was saying, you know, we want to encourage companies to stop doing bad things so that we can invest in them. And so I think sometimes when you're looking at, for example, a fast food company, and you might say, well, you know what, I don't eat fast food and I don't really want to invest there. But if you can convince that fast food company to, for example, reduce the amount of antibiotic it accepts in its chickens or in its beef, then you're having actually you're having a huge impact on farming across the world. And so I think engaging with companies and talking to them about what is acceptable and how to do better is a way. So maybe that isn't a company that you like everything that they're doing now, but you're still going to own them because you're pushing them to do better. And one of the ways this is happening a lot now is antimicrobial resistance, AMR. So this is a very kind of a one of the things that people, that investment managers are looking at with respect to meat is reducing the amount of antibiotic that's used in factory farming, which has huge impacts on the animals themselves, but as well on humans as we ingest that, on the water, pretty much everything. So I think these are key initiatives that if your investment manager is supporting those and talking to companies about them, then perhaps that makes it mitigates the effect of holding that company in your portfolio.
That makes sense. Actually, Leah Garces, the president of Mercy for Animals, mentions this a little bit in her work with Tyson Foods, because I guess they brought up animal welfare, and she got a lot of flack for it, for working alongside with them, etc. And she made the point that, look, like, you know, animal welfare standards will increase the price of chicken that they provide, and it also shines a light on what's going on with the treatment of these animals. And that's done more, she said, in that one instance, working with that company, than any amount of lobbying from, you know, a non-engaged collaborative relationship with them. So it makes perfect sense that there can be a big impact there. So moving forward then, let's talk about Beyond Meat for a moment. It was a huge IPO last year. Pretty much you have to be living under a rock not to have heard about it or seen it everywhere. And the vegan community was clamoring to own its stock. Its stock quickly increased 10 times its IPO price to the $230 range, and then came down significantly. It's now trading around $130 a share. Some people made a lot of money, some lost a lot of money. It might be a terrific company and align with one's ethical values, but when there's a limited supply of shares and a lot of public demand for these shares, the price to own that stock to get out of whack with the underlying value of the company. How should ethically minded investors think about these sorts of situations? Claire, you can kick us off here.
Okay. Well, I think it's about having a diversified portfolio. I think with Beyond Meat, it was obviously a very highly publicized IPO, and being the first, you know, company only producing vegan products to IPO on the stock exchange, that created so much of a hype around it that a lot of people who are private investors that maybe do not usually get involved in the stock market also got involved. And yeah, I would agree, they've certainly had a wild ride. I don't want to get into sort of forward expectations for the company or anything like that, but what I would say is that its volatility has definitely been increased by the initial buying, by a number, quite a lot of short activity which occurred in that period of time, which was really, really painful for the shorts because there was so little stock available, and it really aggressively caused that price to soar. When there was more stock that came onto the market, it sank back, and I think it went back to the 70s. And then it's kind of moved a little bit more stably, more in line with people's expectations. The problem we have is that combination of illiquidity, lack of stock to borrow as well in the initial phases, and then the sheer fact that it's extraordinarily difficult to value a company whose revenues are growing, that has never been profitable before, that is only just turning profitable now. You know, the valuation that you put on the company is a function of the future cash flows. And it's extremely difficult to put a number on what those future cash flows will be because of the newness of the product, because of the rapid growth of the company, the acceleration of demand, the international expansion. You know, so they have high revenues, they also have high costs to do with the expansion, to do with the marketing spend. You have issues of, you know, capacity in terms of production. So there's many variables that are much more volatile in themselves as compared with, let's say, you know, a food company that's been around for the last 40, 50, 60 years on the stock market, where you know, the drivers of their returns, of their profits are very much well known. So I think that investing in these companies has to be done as part of a diversified portfolio. We are providing with the index a version of the stock market, a way of investing into the stock market, which is very much more balanced across industries than investing in just a few companies based on, you know, a certain ethical criteria. And so I think that the diversification is so important. Definitely go into these companies. If you see IPOs, they may be interesting to you. Maybe don't go in straight away. Let the stock settle. Sometimes things get very hyped up, then they pull back. This is totally normal. In fact, in my, you know, years of being in the financial markets, I've seen that happen many times. So I would just be a little bit more careful with those companies because of the very high volatility, which is a natural function of the fact that they are very new, high growth companies, and just put a small amount of your portfolio into them if you want to proactively bias your portfolio a little bit towards them. Don't go overboard though, because you will have a roller coaster ride.
Noted. Sucheta?
Yeah, I think that's actually very important, the fact that your portfolio is diversified. I think you really need to look at, you know, what your portfolio is composed of, and also whether you have the personality to be comfortable with the level of risk as the volatility goes up and down. And this happens, you know, not just with Beyond Meat, but I think Tesla is another perfect example of this kind of stock that people are saying, oh, I really want to own it, and then it's gone crazy, right? But I definitely, what I would echo is Claire's comment that if you want to own these stocks, it's probably safer for you to take a look at a mutual fund or an exchange traded fund that owns them, because then you've got an investment manager who is proactively managing that stock as part of usually a very responsible portfolio. And they will be able to manage that risk and volatility more effectively than you might be able to as an individual investor. So I think the demand for those stocks is really important, because we are showing the market that people want to invest this way. So I think that's really key, and you don't want to not buy it. You definitely want to show your interest, but doing it within a diversified mutual fund or exchange traded fund, I think probably makes sense for most investors.
Great, thanks. Kelly?
Yeah, again, I would echo everything my co-panelists have said, perhaps most loudly, that don't be afraid of these stocks, right? To your point, Sucheta, we want to show demand for the stocks. I know people want to participate in these exploding companies that are doing good things in our view, and some of our view anyway, for the environment, for people, for animals. It's exciting. We want to be involved. Of course, you need to mitigate your risks. I think it's a great suggestion. Get your exposure via an ETF, via a mutual fund, invest relatively small amounts, certainly get advice wherever possible, and have an advisor help you manage your risk. I think we're going to see another similar explosion with Oatly, which I think is the next expected IPO, or perhaps Just. I'm not sure what Just is going to look like. But to your point, Claire, about international expansion, they need a lot of money to do a lot of big things, but suddenly they're big players on stages. They get a lot of press. So I think that volatility is going to be inevitable. Exciting, again, from our perspective of seeing these companies just come onto the market and have a massive impact. So I guess for your viewers, again, if you're looking at the next IPO, thinking about this, perhaps watch what Oatly's doing, see what it projects to do in the next few years. If you think you may be interested in participating in that stock and buying it once it IPOs, and think about how you might expose yourself and how you might get good advice on how to manage the volatility and your risk. But don't shy away. Come participate in it.
Well, on that note, there's a great follow-up question I have for you guys then, because Oatly has been in the news a lot recently, and not just because it's set to go public, but in the way it's set to. They took, excuse me, funding from Blackstone, I believe, and I confuse that sometimes with BlackRock, so thank you, Kelly, for pointing that out. But that's been a constant and frequent point of division amongst vegans and ethical investors alike around whether or not to perhaps boycott companies, because a lot of people are calling for a boycott on Oatly based on the fact that they took investment from Blackstone, who's aligned with Donald Trump, for example, many claim, and perhaps not nearly as aligned with the values and vision that Oatly has for itself. What would you guys have to say about that? I guess everybody's quiet because now I haven't called on anybody. So Claire, how about we start with you again?
Okay. I think companies do need to consider who they take money from, to the extent that they have any power over that. And I do think that Oatly probably did. Obviously, once a company gets onto the exchange, they have no idea who is buying their shares. It could be, investors who are very aligned. It could be activist investors who have, have ideas about how the company could be changed. But Oatly obviously is, something of a star player in this area of plant milk, along with a number of other companies in this space. They're doing kind of pre-IPO financing, in the kind of hundreds of millions. In the same way as Beyond Meat did before it IPO'd. And I think, given the way that Beyond Meat obviously did very well, I think that they probably could have been quite courted. I think there was probably quite a lot of demand for that round. I'd be super surprised if they struggled to fill it up. There are some large players in the private equity space, that would have been interested, that maybe did not get into that round. There are end investors as well that will look at larger private equity deals like that. And I do think it is important for companies to do due diligence and to continue that, to consider that kind of reputational risk. I've seen hedge funds brought down by having the wrong kind of investors, because the investors that they brought in initially maybe pulled out their money as soon as something looked a little bit looked as if it was maybe going wrong, and brought down the hedge fund. So I've been very conscious about this always in my investment career. And it is something that companies should certainly consider, if they have that power, to be a little bit more selective about their investors. Even a company as large as Oatly, it's certainly something that some of the investors in the startup and early stage growth are super careful as to who they have coming into their rounds. They're concerned about certain VCs. They're concerned about certain strategic investors. Yeah, I think it was a bit of a slip up by Oatly to do this.
Kelly?
Sure, so that's really a very interesting point, that we don't know what Blackstone's intentions are. I think that's a great call out, Claire. And so certainly it would be important for these companies to consider whom they're whom they're having invest in their companies, of course. I would say, just to abstract from this a little bit, I think it's a good problem for the vegan community to have. So if we can just stay there for a moment. These are massive corporations interested in getting into this space. Whether they're doing it with not so great motives, I can't say, but just that there's this level of interest from these major players, I think is a good sign, a heartening sign. So I'm glad that there is that interest. Oatly did respond to this. I think they did a pretty good job of justifying why that they accepted Blackstone's investment. Whether that argument's a good one or not, is again will be a long-term matter of debate for the community, and that Oatly will continue to communicate about, I'm sure. But to the extent that Blackstone's intentions are not bad, that they're looking to maximize their investment in the company and see it succeed, and that Blackstone's interest sparks other big players' interest, Apollos, the Carlyles. You see the space beginning to become more invested in these transformative technologies. I think that will be a good thing. I also don't think it would be a bad thing if this conversation were reversed and it were big food companies saying to Blackstone, we're not going to accept your investment if you're in the plant-based, alt protein, cultivated protein space. So in my long-term dream, I'm thinking, well, then that would be a good thing if this conversation were happening among the companies that are doing so much damage to the planet.
Interesting. Sucheta?
Yeah, I think most of all the important points have been made, so I don't have a lot to add, but I definitely feel, I guess on the one hand, that almost everybody who's got a lot of capital and something to provide who could have helped Oatly has some drawbacks that you could have found. But I also think it's very positive, the whole discussion and or outcry or whatever, this issue, because it is raising the fact that we want to change the entire financial system. So it's not just the Oatlys and the Beyond Meats that we want. We want to go up a tier and say, well, the companies that are financing them, we would also like them to look more at environmental, social, and governance issues and say, are they companies that we want to be dealing with? And so to the extent that tier above the company itself that's IPOing is starting to look at its own behavior and its own holdings, I think this is a positive discussion to have.
Yes, I'm just thinking about it from the perspective of the PR that has happened, the press attention that's happened to this. I would hope that possibly within Blackstone, that gives them pause in terms of them considering the investments that they are making, that they may well, as a function of one investment that they're making in a damaging industry, a mine or whatever, that they may be excluded from a deal. Because people don't want to have this this bad press, and that definitely would be a good thing.